Hello, this is Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our mid-year 2026 review and outlook presentation. Now, regardless if you're watching the video or listening to the audio podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlooks. For more details, please contact your financial advisor, and thank you again for joining us. So our theme for mid-year 2026 is a resilient economy continues to push through headwinds. Now let's walk through our broad outlook here. We believe that the U.S. economy is actually stronger than headline GDP growth suggests. The GDP number, as you know, gets revised several times throughout the years, and it's actually a pretty motley set of data. But our biggest complaint about it that people don't dig into enough, we think, is that the stronger imports relative to exports actually is a negative to GDP, just on the face of it, in the way the math works. And it's important to understand why imports might be stronger than exports. If we have a stronger consumer base, a stronger economy domestically than our foreign economies around the world, we're likely going to be importing more than we're exporting. And that's actually kind of a sign of strength. So we actually look beyond that into other things, and we'll talk a little bit about what we think is a more relevant measure. Secondly, the labor market, it's tight but not strong. This is another kind of motley set of data. If you actually looked into how these estimates, which they really are created, you'd understand how difficult it could be to measure the unemployment rate, for example, an economy that has over 160 million workers. It's a quick snapshot. And what we're seeing is some interesting trends there. But again, tight but not strong. It's also not weak. Inflation, we believe, peaked in May. We're actually seeing that in some of the more recent data that's coming out, led by fading energy costs. And importantly, housing inflation is cooling. It's not to say that housing prices are dropping overall, although we are seeing some weakness in certain pockets, but the rate of increase in housing prices has decreased significantly. And housing is a much larger part of the inflation picture of consumption in general, household spending in general, than is energy. Weak inflation adjusted income growth remains our chief risk. We do think that fading inflationary pressure will help this. So the weak inflation-adjusted income growth has not been enough to change our outlook significantly. Corporate earnings are a bright spot. They've actually been revised up in terms of earnings expectations and are expected to be up 24% year over year, which is a very strong corporate environment, which we believe can help support higher equity prices over time. Our positioning, as a result, remains overweight equities versus, say, fixed income, and overweight the U.S. versus other countries. Let's talk about the broad outlook in the table format that we put together every quarter. Monetary conditions, which is basically central bank policies in the context of the broader economic environment, we think are neutral across most major economies. Fiscal conditions in the United States continue to be supportive of growth as the government in general continues to increase spending. Leading economic indicators are kind of directional in the U.S. and mixed elsewhere. Valuations, we think, are fairly valued. And we think that they're fairly valued in the U.S. specifically because there have been this, over the last couple of years, as we've been talking about, the equity market rally has been so narrowly focused that a lot of industries and sectors were kind of left behind and rather ignored. But also we're seeing such broad earnings growth that earnings growth has kept up with or even surpassed stock price increases. So we consider that fairly valued. And across the board, we are cautiously optimistic in our overall outlook. Now let's look at GDP to final sales in the private sector. And this is what I mean when we talk about other ways to measure economic growth rather than just GDP. GDP, gross domestic product, as a measure, has a lot of pros and cons to it, as would anything. Especially when trying to measure an economy this large and this complicated. But one of the things we like to focus on is this comparison to GDP growth and real final sales to private domestic purchasers. So that's inflation-adjusted sales to private, meaning the private sector, not involving government, and domestic purchasers. So it excludes the vagaries of were inventories built up or contracted during the quarter? Do we have more imports or more exports during the quarter? It's really just about how robust is consumption in the private sector, that is households and businesses. And you can see that is measured by the gold line here, and the blue line is the traditional real GDP growth. And you can see how much more volatile GDP growth is, but also in general, private sector economic activity has actually been stronger and is forecasted for the second quarter to be stronger than GDP growth. We think that's been consistent with history. We've been talking about this a lot, especially since the pandemic, because we had those massive supply chain issues and so forth that are really confusing and obfuscating clouding the GDP growth numbers. So it's important to look underneath the hood and see what's going on. And what we can actually see is the private sector continues to drive growth in the U.S. economy, which bodes well for our economic future. We talk about the unemployment rate. One of the knocks to the unemployment rate, as it's published, the headline rate is published typically the first Friday of every month, is that it doesn't count people who aren't actively looking for a job. So if you're not looking for work, you're not counted in that number. And so a lot of people will say, well, the younger generation is just lazy. They're not looking for a job. So that's why the unemployment rate is low. So the way that we've been digging into this, and we've been doing this for a number of years now, is to use census data to count everyone who is 16 years or older. So it doesn't matter if you're looking for a job or not. It doesn't matter if you're in high school or a retirement home or anywhere in between, you're counted in the statistic. And we compare that to the number of people who are working. And you can see this is data that goes back to 1948. So we have decades and decades of history here to look at. And there's a number of trends that we can see over time. And we've written about this before in previous commentaries. But the most important thing I want to focus on today is how low that number is. In fact, we're near an all-time low number in terms of the unemployment rate, just counting everyone who's over 16 years old or over. And so what that means is relative to the size of the potential labor force, there just aren't that many people who are not working. We compare that with the slower growth rate of the labor force. This means we should expect slower jobs growth in the months going forward. Yet the unemployment rate will likely remain low just because there aren't that many people who aren't working. It's not strong, but it's not tight either. Now, moving forward to inflation, this is personal consumption expenditures, spending. So how much do we spend as households on housing and utilities? And this is the percent change year over year. So this is a big piece of inflation. So the energy costs get a lot of attention, but household spending on energy has actually declined from a peak in the early 1980s of about 10% to about 4% today. So even with today's higher energy prices than they were a few months ago, it's still relative to overall spending much smaller piece, whereas households spend much more on shelter, which includes your monthly utility bills, mortgages and rents, as a percentage of total consumption basket, as a percentage of total budgets. And what we can see here is the percent change year over year going back to 1980. And we see we're kind of pretty close to about the norm. Yes, coming out of the pandemic, housing prices jumped for sure, but the growth rate of housing prices has really settled down. So it's a much smaller impact on the overall inflation basket on a percentage change basis, but also importantly on a contribution basis because it makes up a much bigger piece of the pie. If housing prices aren't rising significantly, that pulls out one of the biggest contributions to inflationary pressure. On top of that, we've seen energy prices come down. There's going to be some volatility around that. So we think we've seen likely peak inflation in the near term. So that bodes well for real household consumption going forward, as if inflationary pressure comes down and wage increases continue at a steady pace, that means real, so inflation adjusted income should improve. Now, I mentioned the corporate earnings being very positive. Here we're looking at corporate earnings for the S&P 500 sectors and the S&P 500 index overall. And what we can see is you see the sectors that are where we expect the biggest growth. This is based on FactSet's consensus earnings estimates. So Wall Street analysts looking at earnings expectations. And you can see the S&P is at 24% overall year over year. That's a very strong number. Even if you have some price appreciation, earnings growth this high is really supportive of that. So we think we're in pretty good shape in that regard. So investment implications, we're in general overall overweight equities versus fixed income with an emphasis on U.S. equities over foreign. That's primarily because we have such a large tailwind to the U.S. economy, especially versus other economies around the globe. We are emphasizing areas such as the healthcare sector via service providers. So think about insurance companies and hospitals, as well as the industrial sector and regional banks, in addition to semiconductors and electronic equipment. So the kind of AI infrastructure. So it's not just AI infrastructure that's working, we think. We think it's also a broader set of areas where investors can find great equity opportunities. On the fixed income side, we continue to be focused on high quality asset-backed and mortgage-backed securities focused on the belly of the curve. So not taking a lot of interest rate risk. And that's quite deliberate in how we position that. It's one of the benefits of using ETFs or exchange traded funds in here because we can be quite precise in our positioning. That's really difficult to do if you're using individual stocks and bonds. On the alternative side, we continue to like multi-asset real return oriented strategies. So these are strategies that include things like global infrastructure, commodities, and so forth, as well as options-based equity strategies. So options overlay strategies that have equity exposure to them, but they generate a lot of income relative to the broader, just a traditional equity market, and can help mitigate risk by diversifying our sources of return. Here on the summary of favorite choices, you can see it laid out in more of a grid format or table format, where we also mention our emerging market ex-China exposure. When we think about we're overweight the U.S., our biggest underweights globally are actually in Europe and China. We're pretty much neutral to slightly overweight everywhere else, primarily neutral. And so that gives us an overall overweight to the U.S. The cash indicator. The cash indicator suggests or signals periods of significant market stress where it's not necessarily buying opportunity, but there's something more going on under the hood. And it's an important unemotional quantitative tool. And while the current level is below the historical norms, it's not as low as it was when we were mentioning a couple of years ago that the market was basically overly optimistic, or at least not pricing in enough risk. And we can see that in the dial here, where the dial on the right-hand side, where when it gets too low, the dial gets into yellow. When it gets too high, when the measure gets too high, clearly we get into the red and we're raising cash. When it gets to be too low, it suggests us the markets are overly complacent. But that's not where we are today. We think there's a healthy level of skepticism in the equity market, while the fixed income markets in general reflect confidence in the near-term economic outlook. Combined, we think this is a pretty healthy setup. So if we do see equity market pullbacks, and we do expect volatility for the remainder of the year, it's more likely a buying opportunity and not something to be feared. And with that, I will close by thanking you for your time. If you have any further questions or would like a deeper explanation of any of these points we've made today, please contact your financial advisor. They'll be happy to help.